This is 5 investing tips every investor needs to know. Let's begin. Number 1. Understanding risk versus reward. Understanding this ultimate relationship between risk and reward is crucial in investing because it allows you to make informed decisions about your portfolio. By evaluating potential risks and rewards of an investment, you can determine whether it aligns with your investment goals and personal risk tolerance. This information can help you guide investment decisions and ensure that you are taking appropriate levels of risk in pursuit of your financial goals. Additionally, understanding the risk versus reward trade-off helps you avoid making impulsive investment decisions based on emotions or market volatility. By keeping a long-term perspective and focusing on your investment goals, you can stick to making informed decisions that support the growth and stability of your portfolio over time. There are a few ways to determine if you have exceeded your risk tolerance. Review your portfolio. Regularly review your portfolio to see if the level of risk in your investments align with your personal risk tolerance. If you are experiencing significant losses or your portfolio is becoming increasingly volatile, you may need to reevaluate your investment strategy. Assess your emotions. Pay attention to your emotions as you evaluate your investments. If you're feeling anxious or stressed about the performance of your portfolio, it may be a sign that you are taking on too much risk. Consider your goals. Take a step back and consider your investment goals and time horizon. If your portfolio is not aligned with your long-term goals, it may be time to reassess your risk tolerance and adjust your investments accordingly. Ultimately, it is important to have an open and honest conversation with yourself about your risk tolerance and investment goals. If you are uncertain about your risk tolerance, consider seeking advice from a financial professional to help you determine the appropriate level of risk for your portfolio. There are a few ways to gauge your personal level of risk tolerance. Number 1. Consider your life stage. Your age, income, and future financial goals can all impact your risk tolerance. As you get closer to retirement, for example, you may want to shift your investments to more conservative options. Number 2. Assess your financial situation. Consider your current financial situation. Include your income, savings, and debt levels. The more financial stability you have, the more risk you may be able to tolerate. Number 3. Reflect on your past experiences. Think about how you have responded to past investment experiences, such as market downturns or significant losses. This can give you insight into how you may react in similar situations in the future. Number 4. Take a risk tolerance quiz. There are online quizzes and assessments that can help you gauge your personal risk tolerance. Keep in mind that these assessments are only a starting point and should not be relied upon solely to make investment decisions. It's also important to keep in mind that your risk tolerance can change over time based on a variety of factors, such as your financial situation, life stage, and market conditions. Checking, reviewing, and reassessing your risk tolerance every once in a while can help ensure that your investment portfolio remains intact with your personal goals and risk tolerance. Number 2. Know your investment goals. Determine your investment goals and time horizon before making any investments. This will help guide your investment decisions and keep you focused on your long-term strategy. Here are a few ways to help identify your investment goals. Reflect on your financial situation. Consider your current financial situation and future needs, such as saving for a down payment on a house, planning for retirement, or funding a child's education. Setting savings goals for a down payment or planning for retirement is important because these are typically long-term financial goals that require careful planning and consistent saving. By setting specific, measurable, and time-bound goals, you are creating a roadmap to help you achieve these financial milestones. While taking on high levels of risk with the hope of a huge reward can be tempting, it can also be very dangerous, especially if your financial goals are long-term. The stock market can be volatile and unpredictable, and taking too much risk can result in significant losses that can set you back in achieving your financial goals. Additionally, investing all of your savings into high-risk investments can leave you without a safety net in case of emergencies, such as job loss or unexpected medical expenses. By setting aside savings for specific goals, such as a down payment or retirement, you are creating a cushion that can provide financial stability and security over the long term. Ultimately, it is important to balance out the values of risk and reward in your investments. While taking on some level of risk can be necessary to achieve your financial goals, it's important to make informed decisions and ensure that your investments align with your long-term goals and personal risk tolerance. Set specific, measurable, and time-bound, or SMART, goals. Define your investment goals in a way that is specific, measurable, and has a deadline. For instance, I want to save $100,000 for a down payment on a house in 5 years. And of course, seek professional advice. Consider working with a financial advisor to help you define your investment goals and create a tailored investment strategy. Number 3. Track your portfolio performance. Regularly monitor and evaluate your portfolio to ensure it aligns with your investment goals and make adjustments as needed. Tracking your portfolio performance is important for several reasons. It helps you monitor progress towards your goals. Regularly tracking your portfolio performance can help you see how your investments are contributing to your financial goals, such as retirement or a down payment on a house. It helps identify underperforming investments. By tracking your portfolio performance, you can quickly identify any underperforming investments and make informed decisions about whether to sell, hold, or buy more. It provides insight into market trends. It can give you a better understanding of market trends and conditions. This information can be useful in making informed investment decisions. It helps you stay on track by helping you stay disciplined and avoid impulsive decisions based on emotions. In terms of frequency, it is generally recommended to track your portfolio performance at least once a quarter, although some investors may prefer to do so more frequently. However, the frequency of tracking your portfolio performance ultimately depends on your individual goals, investment style, and risk tolerance. It's important to find a tracking frequency that works for you and to stick to it consistently to help ensure that your investments remain aligned with your financial goals. Number 4. Avoid overtrading. Excessive buying and selling of securities can lead to increased transaction costs and potential tax consequences. Consider a buy and hold strategy instead. A buy and hold strategy where an investor buys and holds onto investments over a longer period of time is often considered better than frequent trading for several reasons. Firstly, it minimizes transaction costs, such as broker fees, which can significantly erode investment returns. A buy and hold strategy helps minimize these costs. Timing the market correctly is very difficult, even for professional investors. A buy and hold strategy can reduce the risk of timing errors, as the investor is not trying to predict short-term market movements. Moreover, on the long term, investments have the potential to compound and grow in value, which can lead to significant returns. A buy and hold strategy helps take advantage of this compounding effect. However, it is important to note that a buy and hold strategy is not without risk. If a stock is declining significantly and is unlikely to recover, it may be appropriate to consider selling the stock and investing in another opportunity. This is why it is important to regularly review and assess your portfolio to ensure that your investments remain aligned with your financial goals. In conclusion, while there may be instances where trading is appropriate, a well-planned and executed buy and hold strategy can be an effective way to achieve long-term investment goals, especially when combined with regular portfolio review and rebalancing. Number 5. Consider the cost of investing. It's crucial for investors to be aware of the fees and expenses associated with their investments. Fees can have a significant impact on overall returns. High fees can erode profits, especially over the long term. But of course, different individuals have different levels of risk tolerance. Some investors are comfortable with higher levels of risk and volatility, while others prefer a more conservative approach. When it comes to investing within your own personal goals, you may find yourself paying for services that track market conditions in real time. Fees and expenses can eat into your returns over time. This is because the compounding effect of fees can lead to a substantial reduction in the final returns. Even seemingly small fees, when compounded, can result in a significant portion of the investment being consumed by costs. If you decide to invest in a mutual fund that has a management fee of 1%, then consider the fact that $100,000 invested would cost you a total of $1,000. Index funds and ETFs are known for their lower expense ratios compared to actively managed funds. These types of funds aim to replicate the performance of a specific market index, and because they involve less active management, they typically have lower fees. As a result, investors may retain a larger portion of their returns. Therefore, before you begin investing, always do your due diligence and consider alternatives or different options to achieve maximum gains. This has been 5 investing tips that every investor needs to know. If you have learned anything in this video, please give it a like and subscribe for more money and investing content.